For those of you not familiar, this is Tradingview.com. It's by far the very best platform out there for charting any sort of technical analysis at all. And so that's the website there, and so we can go over really quickly.
Hey,
sorry, what's that?
It's Paul. Sorry about that.
Oh, no worries. Okay, so let's go ahead and start with the absolute smallest thing. So let's actually go over to some currencies. I'm going to move this out of the way, and so let's start off with the most popular currency out there, which is EURUSD. So if you want to find a new currency when on Tradingview.com, you can just start typing. You just say EURUSD. I didn't have to click anywhere. You can click here if you want, and then you should hit enter. And I'll just go ahead and delete all these markups for now. And so let's talk about what exactly are you looking for in a trade, how to make a trade, and all that good basics. So this chart for the new people out there might look a little bit confusing. I'm sure you're more accustomed to stocks looking more like this. This is called a line chart. And a line chart is okay for a lot of things. It's really good at showing just the closing prices because that's all it does. You can change it instead of closing price. It can just show the open price, for example, or even the high or the low. But as a professional trader, you really want to use the candle chart. So this is where you go ahead and change that. And let me tell you exactly what the candles mean. It tells you quite a lot in every single one of these candles. It tells you 4 different things. And as you can see, there's 2 different colors here. So for this example, we will be talking about these two candles here, the green one and the red one inside this green box, which I know doesn't help. So basically, the color is representative of which direction the price moved within that increment. So right now, what increment we're on the W or the week. If you want to change that, this is how you would change what increment you want to go to. And essentially what a green candle is when it starts at the bottom of the base is where the increment began, which you'll usually see it lines up with the previous one most of the time pretty well there. And it means it ended at the top of the body there, only if it's green. And if it's red, it's the exact opposite. It started at the top and finished at the bottom. The little ends at either side are called wicks. This represents the high and the low between that same increment. So all within this week, in an unknown order, the price started here at the beginning of the green one. At some point in time, it made a low of here. At some point in time, it made a high of, you can hardly even see this top wick here, and then it came down just a little bit to finish at that point there for finishing. And I'll just go really quickly over the red one as well. It's pretty much the same thing. It started here. At some point in time, it went up, and then some point in time went down to this bottom wick, and then finished here. Bird, do you want to go ahead and explain anything else about that?
Yeah, so I mean that's pretty much it of the anatomy of a candle. You know, you have the open, close, high and low. It's HCL. Anyway, open, close, high and low. What everybody looks at. So that's kind of the anatomy of a candle. And just remember that when you look at a time frame, in this example, the weekly, there's going to be 7 daily candles within it, and however many hourly candles, etc. So you know, you get more detail. You tell a bigger picture on bigger candles with more details and more candles, or smaller candles, I guess. But as far as the candle, the anatomy of a candle, that's what you're going to be looking at. And to kind of circle back, because I think it's easier to go from candles to lines and lines to candles. So when you look at a line chart, if you can pull one up,
yeah.
We said all you see in a line chart is the close of the previous candle. Mm-hmm. So you only see the closing price. So that's why he says you have you can see the closes very easily, but it's less information because you don't know where the high and low of that time period was when you look at the line chart.
Yeah, that's right. And one particular strategy that you absolutely cannot use with the line chart is gap filling. So You won't see gaps with line chart, but the price will sometimes, it's actually not quite a continuous flow. If you have a really keen eye, you'll be able to see there's a little bit of a gap in between the weeks. There can be gaps during the week as well, although those are usually much smaller and much more rare. During almost every single week, there's at least some sort of gap. It's extremely rare for there to be zero gap in between the week close and the week open. But with this, you're able to use the gap fill strategy, for example, which is a really basic strategy. All you do in that one is if the price opens higher than when it closed, then you would short it, and if it opened lower than it closed, you would open it, and your take profit would be around where the previous candle opened or closed, or excuse me, closed on there. And that's not the best strategy, but that is a really, really easy one to follow. So let's go ahead and go down to something a little bit more advanced now. Let's talk about, do you think trend lines?
I think you need to even go back up and look at like what's inside of a currency pair. Like when you're trading EU and USD, what are you actually doing to the pair?
Do you want to explain that one?
You probably can do it a little better than I can, but I'll give my best shot. So when you're looking at Euro USD, for example, so actually let me see if I can. Let me take the screen.
Sure.
Sorry, ignore this. Just look at Euro USD, and hopefully when it comes up, it won't have an L for me. Okay, so we're looking at the euro versus the US dollar. So if we look at the right side of the screen with the prices, this is an exchange rate. This is telling us that 1 euro equals currently 1.08192 US dollars. Okay, and if we were to quote buy this pair, that means we want to go up. What we're doing when we buy this particular pair of Euro USD is that we are exchanging. We're exchanging euros for dollars, obviously, with the hope that it goes up. Blake, I'm gonna let you do this because I'm way more better at the technical.
Yeah, go ahead and keep your screen on. So basically, what it is the second currency is called the base currency, or yeah, and then the first one is the counter currency. So EU is essentially buying euros with dollars. I think I have that correct. So I get them backwards sometimes. And so you can actually buy money with money. And where it gets a little bit confusing for new people is even if you funded your brokerage account, let's say in US dollars, you can still trade two completely separate currency pairs, such as, we'll use euro again, but this time we'll use the GBP or the pound. So this is EG is what it's short for, and is the shorthand for that. And basically what this one would be is instead of the US dollar being the base currency now, it's the pound. So it would be buying euros with pounds.
Mm-hmm. Yeah, so, and that was one of my first questions, because Blake is the one who introduced me to trading. My first question was, how do I trade euros for pounds if I don't have the euros to get euros, buy euros, and then get pounds? More or less, that's done with your broker instantaneously and automatically, which is kind of how I can get confused about the actual mechanics of it and still be successful as a trader, because it's kind of taken care of, it's aggregated out. But basically, if I were to say I wanted to sell this, so and the selling basically means I think the exchange rate will go lower. If that happens, then that means that I'm glad I have this actually in the back. If I were to sell Euro GBP, that would mean that I would want the value of GBP to go up and the value of Euro to go down, or one or the other or both. Because if you think about it, if this gets higher, then it's a division problem. So the higher value that GBP would have in this example, the lower this value would go. So in that instance, I would actually be buying GBP and selling Euro, versus if I were to be buying this pair I will be wanting the value of euro to go up relative to the value of the pound. So it's kind of more or less the mechanics or the fundamentals of like what's actually happening when you're buying a currency pair. So just to kind of reiterate, say that for one reason or another, whether it's technical, which is me looking at the charts, or fundamental, I say, okay, I think that the pound is going to become much, much weaker. How can I capitalize on that? So if I say to myself, okay, the pound is going to become weaker, value of the pound is going to go up, that means that this division problem is going to have a higher value, right? So that means this pair is most likely going to go up. So I want to buy this pair. I want to buy Euro GBP and to go up. Conversely, say that I still think the value of the pound is going to go down, but this time I'm trading this pair, which is the pound versus the US dollar. See, it's the division problem.
So
if I think,
the pound switching places.
So now the pound is the first pair. So if I think, okay, the pound's going to get weaker, that would mean that I would want to sell this pair, because if you divide by a smaller numerator, then the value is going to go down. And you can see at current price, 1 pound equals 1.16 US dollars. And I think that's like pretty much the mechanics of what happens on a currency, on forex, which is like my main thing. I've been trading indices a lot recently with the market, but I think we can get into like the actual technicals. Unless anybody has any questions about like the mechanics of or the fundamentals of actually executing a trade.
I don't think so. I think we're ready to go ahead and move on.
Yeah. I think a good place to start will either be trend lines or support and resistance blade.
Okay. I'll go ahead and take over then.
All right. Here, let me get your screen. If I can.
All right, so I know that the chart colors keep changing. That's just our different preferences there. So
whenever I start trading bad, I change my chart colors. It usually works.
So there's a couple different ways to show this. So I think I'm going to use the replay feature for this example. Let me see if I can already find anything eyeballing it. So yeah. So I'm going to go over two different strategies right now, and I'm going to show you exactly how you would be able to capitalize the most out of this. And keep in mind, I am cherry picking this example, so this is not a 100% fair example, but it is really good for the purposes of showing you how all this works. So actually, I should use the full line. So when you're looking for a trend line, excuse me, not a trend line, but a PRP, which is price reversal point, you want to look for somewhere that has a very, very significant high or low value. So there's two right here in where I'm circling. There would be this high as well as this low here. So in this particular case, both of these points would be valid points. And essentially what you want to do in this particular scenario is we saw the chart would come down. There's a plethora of reasons that you could say that why you'd be looking for a short in this area. One example, just to name one, it's a Gravestone Doji is right here, the red one, just as an example. And that is something that we'll get into in a little bit. Don't worry about too much yet. But basically, where exactly would we want our stop take profit, to be? It would be on these two lines. So we could have two separate trades. The first one taking profit there if we enter now for the short selling, and the second one would be on this line. And we do these two specifically just with this strategy because it has the PRP price reversal point, meaning if price is going to reverse at a point, it's very likely to be one of these 2 points. Reverse to the upside is what I'm referring to. So we're confident about the short side, so I'll leave the stop loss alone for now. We'd have one trade ready for this. Maybe let's be a little more realistic. So we'll put that there as a small trade. Keep in mind we are in the weekly time frame. This is a big time frame. And then for the other one, it would be we'd enter both at the same time, just allocating half of our total position amount to each one, and for the second one we'd have our take profit here. We fix the stops just to make it a little more realistic, and this is exactly how you'd set up this trade. Now here's something that a lot of people don't teach you when they're talking about the PRPs, is that you should not have your take profits at the lines, nor should they be, or for sells, they should not be at the line or below. They should always be above the lines. This is because of spread, which we haven't talked about yet. I forgot to talk about who will.
Actually, you should probably go over spread first.
Okay, yeah, we can talk about spread. This is a horrible time frame to talk about it on.
Go on one and see if they have, you have it on your screen, so you can just talk about it with the bid and ask.
Let me. I'm switching screens just so we can do this, and we'll go on to the 1 minute chart. So we can hopefully see it a little better. So if you see this little panel here, this describes both the buy and the sell price, or also known as the bid and the ask price. So whatever the current price is showing, it always shows the bid. The bid is 99.999% of the time the lower of the two. The only reason that the bid would not be lower is if there's a negative spread, and that's something that is extremely rare and only happens in extreme high volatility times in the market. And
let me interrupt you really quick.
Yeah.
So if you think about, so I told you guys the way, say you wanted to trade pounds and yen, or two currencies, or any currency really, your broker does that automatically for you. The way that most brokers, or all brokers, make money is from the spread. So right now, for this pair, it's currently 0.3. So essentially, if you're buying, they will give you the higher price, and whoever you're buying from, they will sell at the lower price, and the broker will make the difference in the middle, and that's kind of how they pay their bills, and that's kind of how they, it's kind of like the zero on the casino table is the way I think about it, or the roulette table. That's how they, pay for the execution prices, how they pay for their infrastructure, everything. It spreads and commissions, and they're kind of separate. So the spread is one way is, you'll get a slightly worse price than when you execute, and the commission will be that you have to pay a fee per trade or per trade size. And that's the simplest way to explain it, why that exists. So I just wanted to that's the best way to explain to me is pretty much the fee for playing games. You can't get the actual price you execute at. So when you see a broker, a lot of times they'll say like the lowest spreads or the lowest fees because it's just like the cheapest broker to play on.
Yeah, not to backtrack too much, but we actually have not talked about what this number represents. So this is pips. When you're on a major currency pair, which by the way there's 7 of them, it's 7 countries' currencies against the U.S. dollar. So there's 8 major currencies. There's 7 major currency pairs because they're all against the U.S. dollar. They all have very, very low spreads. They're very, very typically under 1 whole pip. That would be a little bit weird to see on a normal time, to see even above a pip for euro, for example. Yeah, so what 1 pip is a measure of movement, and it's 1/1000th of a dollar. So if we look at the right here, I can't zoom in on this, but hopefully you can see it. It says it's moving. I'll just look at I'll mark it so that it stays, so that we can see what it is.
And
all right, so
so I
was going to say that this one here that I just marked, we'll look at that one. There's a random price I selected. It says 1.07843. So the number 4 there is the pip, not the 3. The 3 is a micro pip, or some people call it a pipette. And so that 3 is actually the decimal. So you'll usually see pips in it only having 1 decimal after it. So it'll be 1.8 or 1.2 or 50.4. And that's referring to the last column. So there's 4 digits. The 4th digit makes up the pip column, and the fifth makes up the pipette or micro pip column there. And that's just a way to measure movements. That's all it is. Measure price, excuse me.
Yeah, so like you said, a pip is 1/1000th of a cent, or the way I think about it is that 100 pips is 1 cent. So if you have, 100 pips from Euro USD, it will go from $1.08 to $1.09.
Yeah, that's a really good way of thinking of it.
Yeah.
So moving back to these, there's the spread is actually pretty much nothing to worry about on any major currency pair or any index that you normally find on a chart. It's really not something you should worry about, especially when placing trades. However, the exact reason why I don't suggest having your take profit exactly at a PRP is because of the little bit of a spread. So if you had your if we were using this point example, then price might break through while I'm talking about this. But let's just say that price was going to exactly bounce off this line here, because this is a 1 minute PRP, super small, not a real price reversal point. But let's just say pretend like it was. If price hit it and your take profit was at the line and then it bounces off, it would not count as a closed trade. It would not take out, because when you're selling, the higher price, the invisible price that we can't see, it's about where my cursor is right now. I'll keep updating as it's moving. This is the price that has to actually hit your line. So what I'm suggesting is you just move it up just a little bit. Whatever the average spread amount is normally about how much I add to whatever this is, so that if the price hits exactly on the PRP, it will actually take out. Some brokers, such as C-Trader, can actually choose to have a take profit and stop loss in for the opposite side, which would be the bid in the sell case, or the ask in the buying price for take profits. But that's not something you'll see on MetaTrader 4 and 5, which is actually a pretty good segue if you want to talk about that.
Yeah, I think maybe circle back to that on the end.
Okay.
Yeah. So can I grab the screen real quick?
Of course.
So just to kind of go over support and resistance, because the reason I think we should start with support and resistance, is because it's kind of the simplest way to trade. It's an effective way to trade, and it's what most people are taught. And we kind of have a perfect example on this pair I had here. So generally, you'll look at a pair, and you would say, okay, it's found support around, you say, 1.43 around here, and it has, let me type it in. That's a little bit too low, but you say it's found some support around this price, which is 1.45. So you say, okay, it's hit this price once, bounced off, hit this price again. You would say, okay, I would expect if it comes there a third time, it will find support there, and I will look to buy there. Very simple way to trade. It's not terrible. That was a loss. So I can pull up another pair. Let's say USD JPY.
Hey, Bert, quick question real quick. Go back to EU.
Yeah.
So how you had your line?
You or EU? I was on GU.
What were you at? GU just now?
Yeah.
So what if you drew a rectangle box from your wick to your body, so you see price action? So that might be better visual. Does that make sense?
Yeah, I know what you're saying. I just didn't want to really get into that. I mean, honestly, the way I would have traded this, if I was looking at this, I would have traded it here. But I would have traded it right there and bought there. But that's kind of something I don't want to might not get to tonight.
Yeah.
But yes, I'm just explaining what support and resistance is. And if you look at, let's say, the pound versus the Australian dollar, and we go on a blank chart, you can say, okay, these are 1 hour candles. You can say, okay, we seem to have found, support and resistance between these two levels, like this general area here and this general area here. So you can say, okay, I want to buy here and sell here, and then, you would lose that one. But for the most part, you would be looking at these points, and it's, it's 400 pips between them, because it's a lot of volatility. So it's a solid strategy. It's a solid thing to have on your chart, have those areas of support and resistance delineated. So that's kind of the most basic way. It's a solid way to trade. I know you use Hall. You put Hall. You use support and resistance or supply and demand heavily, and you're successful doing it. So, all right, I'm gonna pass it back to Blake now.
Sure. So now that we know support and resistance, it's very, very similar to PRPs. Or let me go back here to our old example that we were looking at earlier before we got a little sidetracked. Basically, the way you do this is like we were saying before. There's a PRP here and a PRP here. Generally, you want the reverse of the whatever one you're coming to next. So if you are coming from a higher point, you do want to find a PRP that was recently makes a mountain, essentially. This is the mountain I'm referring to. And so you'd want your first take profit here. So that would definitely be a better one to have, even this other one, even though they both ones would win more. As a rule of thumb, that's more of a very conservative way to do this strategy. So I'm going to go ahead and play the chart. Hopefully it's not too fast. Oh, it needs to be a little faster, actually. So as you can see, there you go. It bounced off the chart. I don't know if we saw that. It bounced off that point really quickly and then broke it in the same candle and then broke it again on the next one. And we see here the price hit off this point, just a little bit lower, and then bounced straight back up for a little bit. So that's how we know that this would have been a really, really nice point to take out at, because keep in mind these are each a week, so you don't want money to be just being wasted for an entire week. That would have been a really nice take profit, even though the price eventually would have gone lower. That would have been a nice place to actually get out. So I want to see if anyone has any questions before we move forward with maybe a little bit more advanced strategies now.
Yeah. And if you have questions about actual strategies or like a little bit of the fundamentals behind trading, please feel free to ask.
I had a quick question. So when you mean take profit, you mean just selling, right? And then not losing money? That's essentially what you mean by take profit?
Do you want me to explain?
Let me try first, and I'll hand off to you. So essentially, because we were already short selling originally, we wouldn't necessarily be selling. The correct terminology would actually be to just exit the market. So it's not necessarily selling. Even in a buying scenario, it's not necessarily selling, because selling would refer to actually short selling in terms of forex lingo. But I'm sure you got the concept correctly. You'd be exiting the trade there.
Yeah, and I agree. When we say take profit in the forex terminology, we literally just mean exiting the trade. And a lot of times, most of the time, you do that automatically with your broker. You'll set a take profit where they will exit that price at a gain automatically when price hits that level. Or you can have a stop loss, which is what Blake has at the top of the red, where if you're in a loss, it will exit automatically. Forex is a little bit weird because when you're swapping pairs out, but like say we're looking at Amazon, right? Or any other stock that's like one-sided. If you're selling, then and you're exiting the sale, you're actually buying your position back. So when you do that, if you sell it at one price and you buy it back at a lower price, that what you make is the profit. You sell it and you buy it back at a higher price, then what you make is a loss. So technically you're buying it back, but for forex and when we're talking, we just mean exiting, because once you buy it back after selling it, there's like no open trades. Your equity is the same as your balance.
Okay, thank you.
Does that make sense?
Yep, thank you.
Okay. Yep.
That was a really good question. Which strategy should we talk about next?
Go right into the trend lines. We'll do support, resistance, trend lines, and then we can get into a little bit more.
Is this one? I'm trying to eyeball it. It looks like
that works fine.
It looks like it missed it by a little bit. It went a little lower than the trend line, but we'll look at this. So if you want to make a trend line, the most efficient way to do it is to use the ray tool right here. You can use the normal trend line, but the ray tool will actually be better if you're looking for a third hit on a trend line. So yeah, like I expected, it did break it by a little bit here. And essentially what a trend line is it's similar to the support resistance, except for it's a diagonal line. And as you can see, it worked fairly well. It originally hit this, bounced off. We know that because it's a wick. And then it started low. It gapped over the week, so you can see because we're on the week chart. And then it came back up.
Yeah. And, what kind of the way Blake and Paul and everybody who trades, we kind of develop just tools pretty much and know when to use them and when not to use them, or what we like and what we don't like. And support is a tool, resistance is a tool. And I never explained resistance would be the opposite of support. I'm not sure if you got that, but and trend lines are a tool. So trend lines trend lines are simple. The thought is that, trend lines are usually respected in some degree. So, see a trend or a price falling trend, you will want to trade with that trend.
Yeah, not to get a little too advanced, but basically one of the major reasons why these strategies are valid is because of what they teach you on tests like the SIE, the Series 7, even the CFA. For example, on the CFA, they teach Elliott Wave theory, which is known as the CFA is known as a very high-end exam. It's a very challenging exam. I haven't gotten it myself, but I do have a friend who's taken it, and he let me know that there's a decent amount of Elliott Wave questions on the exam, which I thought was really interesting. And so that's just to show you that the people with the real money, people that work for was it BlackRock, for example, and other large hedge funds, those people have their CFAs, and they do respect these strategies as well. This trendline one is one that you'll see on. Remember, this was a question I have taken the 65, and this was a question on there was for trend lines. So these are actually fundamentally backed technical analysis.
Right. Yeah. And yeah, for sure. Any other questions? And we're just, I know we're kind of rifling through a lot quickly, but I personally like to get to like what I look for on trades, but we kind of have to build up to it.
How do you think the best way to build up to that is? What kind of basics do you have to know to understand that?
So I think the way I trade, you will have to understand like the players in the forex market.
Okay.
And I can I'm not sure.
I'll go ahead and stop my.
I guess we can talk about that. I can talk about it if you want me to. I can bring the charts out.
Yeah, let's go ahead and do that.
Okay, so and I haven't traded. I've been busy with school and work, so I haven't traded a whole lot. But this has been a crazy pair. I'm glad I haven't traded this one. Let me just pull up a blank chart really quick. And that's Wyckoff theory. So anyway, I'm just gonna. I'm not sure if that was a good trade. I'm not sure if where I should start, honestly. Okay, so we just talked about support, resistance, trend lines, and they are valid theories, but it's not exactly what I use to trade. There's a lot of like names where I use a trade, but let me go back to. Hopefully, I still have this marked up and I can really explain it. Let's see if I have it. Okay, perfect. So this is like one of my favorite charts because I usually teach on. So let me just talk for a quick second. So forex in particular, I use the strategy on everything, but forex in particular has some really big players. I think like 80% of the volume is traded by like 6 or 7 different banks. So Deutsche Bank, JP Morgan, Barclays, etc. So they have really, really, really big position sizes. Position sizes that we can't fathom, honestly. Their position sizes are so big, in fact, that if they can't order all of it at the same time. They can't enter the entire trade at the same time. Because if they would, the position sizes would be so big. Let's see if I can go back all the way. Hopefully I can. 1 second. This is from a while back. Hopefully it lets me go all the way back. Okay. And don't worry about reading this right now, but the position sizes are so large that when they enter it, it would shock the literal currency markets. It would be an influx of billions or trillions of one currency at one time, and they would get manipulation charges, which actually happened to JP Morgan a few months back. They got fined like $1 billion, something crazy, because they were trading too big at one time. Okay, so is it right with me?
Yep.
Okay, so because of that, they have to enter their positions in a certain fashion. Okay, and also because they trade so much in the market, they are typically trading against themselves. Like, this is all their money. So what they have to do is they have to entice retail traders, which would be me, like people who don't work for institutions, essentially. They have to entice retail traders into a trade. But let me back up really quickly. So
that's to provide liquidity.
Yeah, to provide liquidity, essentially, so they can enter their trades. So let me just draw a candle really quick. So this is a sell candle, right? So let's say that let's just bring it over here because this is where I had. Let's say that I want to buy this pair. I want to exchange Canadian dollar for US dollars. I want the price to go higher. I can't just buy a bunch of US dollars and sell my Canadian dollars at once. What I actually have to do is I have to create liquidity. And what I mean by that is, if I can, I'm on my laptop, not on my computer, so I'm a little bit not dexterous. So I don't have to, but what they were likely to be doing is driving the price down. So they will actually be selling in order to buy. So as they sell, they will push the price down lower and lower and lower and lower. And while they're selling here, they will be, let me get a draw tool. I can't find it. But while they're selling, they will be entering buys in here. They will buy, entering a lot of small buys or relatively small buys, so that when they wanted to get out of these sales, when they want to release the sale, they have buys at low prices. Boom. They get out of sale, price goes up, because remember, when you're selling, when you exit sell, you're buying back. So finally, they tip the scale so that the buys are more than the sales, and the price goes up. Now, if we have buys at this particular price, of course, there's different banks, and this is an oversimplification, but the way I think about it is that the banks don't lose trades. Okay, what they do is they get out at break even. So how do I figure out what break even is? The strategy I use is to open the candle, open up a particular candle, and I'll show you which candle you use. The reason I use that is because a lot of banks or hedge funds use algorithms to trade. Pretty much all, the vast majority of them do. And these algorithms usually activate at the beginning of or closing candle. So there's a disproportionate amount of trading volume at the very open of this candle here. Okay, so instead of like they're selling here, selling, entering buys, and price goes up. So in order to exit the sell, they hold it in negative. They hold it in drawdown until they can bring price back to where the majority of these sales are. They exit the sale they exit another sale at break even at 0, and then when they exit that sale, price will continue to fly up. And that's what we see. You guys see that a lot, and which is why when we're looking at GU, I said that I would have entered here, where the sale went down before the move up. I would have entered there. That's why I said that. I should have gone to that chart though, so now I got to come back to this one. So that's one thing I'm looking for. I'm looking for the counter move, right? I'm looking for the move down before a move up, or the move up before the move down. Hold on, give me 1 second. So this is the move, bottom move down. If you think about it, this is why would price turn around here, right? There's no reason for it to turn around. The people are exiting sales, but they wanted price to move higher, so hits this, exits sell, and takes off. Okay. Now, if we come here and look at this structure, right? Price is clearly in a range. Okay. I'm going to keep on here. Price is clear in a range. You got support and resistance, which I actually don't use, but it's not bad because you could have won. But when we look at this, we say, okay, this price has really made a range here. Because of that, there's going to be a lot of liquidity or money here. There's stop losses for people buying, so people who are trading like this, and my color is a little bit different in place. People who have stop losses here, they say, okay, if it breaks this support, it's fine. And people who are shorting here, so say, okay, if it breaks this support, I want to sell. So because of that, there is a lot of liquidity or money in this area. So if you look closely at this structure, what we see that this is purged. Oh. See that this level is taken out, and where does price land? Pretty much right where this move went down and takes off. But not only that, it does the same thing to the upside. It takes out the upside, and then price goes way down, and it ends up, cratering. But so I try to find liquidity in the market, and liquidity is either above highs or below lows, or a move down before a move up. I'm going to show one quick thing that I actually sent over a few of my previous charts, and you might be able to see what I'm talking about if I have a better example. And I'll share this for everybody too, if it will load.
Do you want to put your Slack link in the chat?
Yeah, I'll put it in the chat really quick. And this is a trading chat. I talk about trading, but more so investing, personal and professional development. Actually, it's loading pretty slow. So I'll give it back to Blake, and that's the very, very quick thing. Well, one second. Very, very quick thing that I look for. So like, if we look at, let's just be a good example. I'm not sure where this is actually, where this price is currently at. It's not even loading. All right, don't worry about it. But yeah, and I'm not gonna get the fields right now, but yeah, I'll pass it to Blake, and I'll put the Slack in the chat so you guys can join it.
All right, so let's go back to the chart. I still have it on Amazon right now. So I want to talk about a little more my specific portion of the market and what I do. Let me turn on my light right here. There we go. So you guys can actually see me now. And so what I do mostly is I focus on 2.5 indices. So it's the US 30 and the SP 500, and the half is the NASDAQ. So I'm not a huge fan of the NASDAQ because I feel like it's just that awkward middle ground in my opinion. So I do look at it every now and then, but I do prefer either the US 30 or the SP 500. So let me, I don't think I need any of this. Let's just see what this one looks like. Okay, so this is how this is the primary way that I trade. If you are in my my Telegram group, which I know Ray is, then you would have seen this chart, or not chart, but the trade that I made today. It was very similar to this one. I marked it up on the SP 500 as well as the US 30. I noticed that the US 30 will have a better risk-reward ratio, which is
US 30 is Dow Jones, by the way.
Yes. And the risk-reward ratio number is right here whenever you're making this chart. So if you want to get out this tool, by the way, it's right here. It's a short position or the long position. In this case, it's a long meaning buy, short meaning sell. And so essentially, I looked at if you were going to have, I'll see why this red line is important. This is a very critical price line. Made a YouTube video on that recently, and what this is basically it was determining which of the counts it was going to follow. Ignore the counts for now. I can explain that a little later. But this point here, if price breaks below this point, for the counts, it would matter a lot, because it would mean that this point is in fact a 3 rather than a 1, which I'm not going to get into just yet. But basically, that would mean that that price is allowed to go much lower. So it's a big deal right now if price is going to break this exact line right here, and we're just so close. But I have noticed there's something called a Japanese candlestick that has just formed. Let's try to zoom in on this. Just formed on, or it hasn't formed on the week yet, but it's currently in a Japanese candlestick. I think it maybe like a 3-day or something you'll have it. But that's what this symbol is here, and this is a reversal symbol, especially with such red candles behind it. And basically what that means is it's very likely that we'll see a reversal in the stock market pretty much now. Now meaning within this week, next week, or the week after that, is when we really should see an upside potential move. So I have a fib on here as well, which I haven't talked about. So I have a lot of stuff on here that we haven't talked about yet. So let me start with the fib. I feel like that's the most basic of any of these things that are on the chart right now. Let me go here. So let me just delete.
Any questions, John and Kendall? Ray. All right, cool.
So basically, what this is a Fibonacci. So this is made off of the golden ratio. The golden ratio is you've probably seen it. It looks like a snail shell, where it starts really small and then it gets larger of a curve at an increasing rate. And then if you look at the mathematics behind it, essentially how you calculate the golden ratio is you start with the number 1, and you take the 2 previous numbers to get the next number. So you go 1, and then 1 plus nothing will be 1, and then you go 2, 3, 5, 8, 13, 21, and so on. And essentially what happens is as you get larger and larger numbers, that ratio approaches 161.8%. That's going from a smaller one to a larger one as you go higher and higher numbers, any adjacent to numbers. And what's really cool is if you go backwards, it'll be normal 61.8 instead of 161.8. So this number here, 61.8%, is extremely important to the Fibonacci. It's the number that all the other ones are based off of, and it just so happens to be a way that the market tends to move as well. In particular, I haven't talked about this yet, but B waves tend to go. They usually make it up to the 61.8, which is why I have the take profit there.
Let me interrupt you really quickly.
Yeah.
So we talked about Fibonacci's, and that used to be, still is, a very big part of my strategy. So the markets in general are a reflection of human nature, and human nature has an affinity for the golden ratio, which is 0.618, and that's why a lot of times you'll see, that number, or that ratio, come up in the markets, because it is a reflection of human nature. It's kind of by accident, but not by accident. You know what I mean? So I just wanted to put that out there.
Yeah, I think what might be a little bit better way to phrase it is it's a strong tendency. It's not a rule.
Yeah.
So when I place take profits, a lot of the time I will use the 61.8 as a general point for a take profit. There are certain things to look for if I'm going to use one of these other numbers. These other numbers are very important as well. And I can explain what some of them are. I don't want to go into detail on the end ones, because that takes too much math and it's too boring. But essentially the 50 line would be, the 100% would be the first one, the first ratio, because 1 and 1 are the first 2 numbers in the Fibonacci sequence, so that'd be 100% retracement.
Like, I think you should show what you're actually retracing now.
Okay, yeah, that's a good call. So it's talking about this as the original movement from this high to this low. And then right now I'm saying that this might be the actual low. It could go just a little bit lower, but it shouldn't go much lower. If it's going to follow this analysis, it could follow a different analysis. Let's provided that it does. This is the low, let's just say. And if this is the low, well then how much is it going to retrace upwards before coming back down for a decent size wave, meaning price movement in a row? And so if it came up this much, that would be exactly 61.8% of the way up. And if it came up 100%, it would come up to here. But then the next number after it goes 1, 1, and then 2. So 2, not to blow you guys' minds right now, but 1 divided by 2 is 50%. So if it has an initial movement up, the very first initial move up generally comes up to the 50, bounces off a little bit, and then tends to come up later on to the 61.8 area after that. And so that's why I usually have my take profits there as a ballpark, and I look for a couple other things to make sure it's actually a good number. In this particular case, it does look to be pretty decent. But let me show you why exactly I chose to call it the US 30 rather than the chart on the screen, the SP 500. SPX is SP 500, by the way. And that is based off of this critical price line here. And it's the same point on this line is right here. It's actually this one. It's a little confusing why it's not the very top one, but just trust me on this one. It's this one or this one. I forgot which one. It doesn't really matter. The line is correct where it is. And I had to actually adjust it a little bit. I had to double check because it came down so low. So even though these are very, very similar indices, we can see, it's a little hard to see. Let me move this over. We can see that on the US 30 version, the bottom of the wick came much closer to the critical line. So therefore, even though it's the take profit moved down a little bit, should be a little higher than that, it's still just at the 61.8. Keep in mind below, as I said earlier, we're talking about the PRPs. It has a better ratio because the stop loss is smaller. So this one has a risk-reward ratio of 9.1 or 9.91, while the SP 500 one had, I think it was 5.6. This one's a much better ratio, even though it's getting the same percentage in the movement, just because it's mostly due to the stop loss being significantly smaller. And these are different ways that I get an advantage in the market, because there's a good saying out there that is there's only 3 ways to beat the market, and that is to be smarter than everyone else, it's to be luckier than everyone else, and oh gosh, I'm ruining it. I don't remember the last one. Have you heard the phrase? I shouldn't have brought it up. And it's, gosh.
I've never heard of it.
Wow, I hate saying half of a phrase. I'm sure if you Google that, it'll come up. Is someone typing out what it is? But I did butcher it. I'm so sorry. Anyways, you want to be, if you can't be smarter than everyone else, or if you can't be luckier than everyone else, you should try to be smarter than everyone else by having proper strategies, such as taking profit a little before the 61.8, because as Bird was saying, he was mentioning how the banks know where people have their take profit, stop loss, and everything. So if you were to be an average person that has learned traditional Fibonacci, then you might have your take profit exactly at the 61.8. But if they don't want so many people to win in the market to have their take profit be hit, they could stop the price a little bit before the true price is hit, and then you would still win. You would still be taken out, while the price may fall directly after, which is why I have that on there. I'll look up that phrase. Bert, are you able to take over so I can look up that phrase?
Yeah, I'll talk about Fibonacci.
All right, go ahead and take over this thing.
So Blake talked about Fibonacci. Delete it. Oh man. Oh, here it is. Okay. So Blake talked about fibs, and I'm gonna give a good example because I was using these. I've been using these all week. So one way to think about fib retracements is to think about it as a discount on the price, right? So I posted this in my chat, in my Slack channel. Well, when I posted it, it was like this. was, sorry, I have all these like Zoom windows, so I can't see my whole screen.
Oh.
But, shit. Let's take
I got it.
it. What is it?
It's faster. That's
Oh,
like
faster,
that's
Yeah.
that's those machines on Wall Street that they see people's data coming in. They make a counter trade real quick. Robinhood does that, for example.
But anyway, so like I was looking at this, and typically when I enter a trade, I want to enter between a 0.61 and 0.78. So at this particular time, at this particular time, we were here in the market, or vertical. We were here in the market. I can't find the bar replay for whatever reason. So, and I said, okay, I'm gonna be looking to sell at 71, and I'm gonna be looking to exit around, or first target will be 18,300 is what I said, because this is another fib level at negative 236. You can get into that, but essentially I'm looking to sell at premiums and buy at discounts, right? So if we look at this entire range here, I'm gonna stretch it out a little bit. If you look at this entire range of prices, if I can get it on the screen. Not quite. Okay. Boom. Look at this range of prices. With with 0.5 being the midpoint right here. And everything below this would be considered cheap, and everything above this would be considered expensive. So I want to sell when it's expensive and buy when it's cheap, right? So I sold pretty much here, or in this area, and I targeted, here. I'm kind of going back to what I was just talking about. When you look at the open of the last move up before the move down, or the open of the last move down before the move up, that actually could have been a very good entry right here, right? Because it sold at a very good price and had very little drawdown, which is negative movement. I don't use that strategy as much on the indices because of the way they're comprised and the way they're evaluated. But there are instances where it works a lot. So that's fibs in a nutshell. And you see, I should probably just enter another trade here because I had this set here. So if you look at the 15-minute chart, which is where I drew this box from, not quite here. I was looking at, this is imbalance, which we'll get into, but generally this area here is where I was looking to sell, and if I sold beginning of this box, it would be just activated and slightly in now. So we'll see. And you see I have level here, dollar sign, you're looking to attack this level. So you pass it back to Blake. Can you use the DIA index in place of US 30?
Yeah, I can do that.
Oh, no, yeah, I was just reading the rates. They're the same thing. US 30 is, the reason I use US 30 on Tradingview is because they're open, not just from 8 to 5 New York time. So you can see the movements that are aftermarket, like this time of day, right? So yeah, that's the reason I use US 30 when I'm charting. Because if you go like on the Dow Jones Industrial, it will be closed during the time market's closed.
That's a really good point. I actually literally just uploaded a video on my YouTube yesterday about exactly why to do that. But this essential reason is exactly what Bird said, that as you can see right now, this very second, we can see the price changing before our very eyes. 57 more minutes till this candle closes. It's 1 hour on the US 30. However, if I was going to go on to the DJI, for example, it's just stagnant, and there's no movement happening on there. So it's like trading futures. So it's very similar, except for it's CFDs, contracts for difference, is the very exact thing. And so if you're typing US 30 on here, you'd find it in the CFD column. So it'd be right here. So any of these works, or you can just hit enter, and that'll work too for US 30. But if you type in Dow, it even comes up here as a index CFD from the top one here in the CFD column. But in the all, it has the stocks. Here's a CFD. That's a DJI. So even though this one's a CFD as well, it just doesn't work the same. It matters. So the TVC does not get the after market hours, nor the before market hours either. But the Awanda does, forex.com does, and FXCM does. And there might be other ones too, but those are the main three brokers on TradingView that I get the information from, as well as checking against my own broker chart. My own brokers that I would actually use aren't any of those three, so they aren't available to see them on TradingView, but I'm able to see them on the trading chart. So we keep talking about brokers. I can talk about brokers really fast. Do you think this is the right time to do that, Bird?
Yeah. We can talk about brokers really quickly, but answer me this question, or correct me if I'm wrong. When like me and you are trading forex, we're also trading CFDs, right? We're not getting actual. Like I'm not getting euros. I'm not acquiring pounds to trade. We're trading contracts.
Yeah. So spot trading. So yeah, it's CFDs. It's just a contract. However, it depends on the broker type that you're using. If you have a premium account, there's a lot of brokers that offer the premium account. That's usually where you're trading against the broker. The broker doesn't necessarily take a counter trade to you in the real with the banks in the real market.
Right.
However, if you have an ECN account, that stands for Electronic Communication Network account, and there's another one too.
STP.
Yeah, STP, right? Straight through processing. Those are both going to be. Well, STP won't. STP will be directly with the banks, but the ECN will be exactly matched by your broker with the banks, so that if you make money, the broker will make an equal amount of money. Therefore, you're on the same side. However, if you have what's called a DD broker, which is dealing desk, which is what most premium account options are, then you'll be trading against the broker most of the time, and until you start winning enough, and they'll finally start siding on your side. But they'll usually be just not backing you on a lot of times, and that's how brokers will lose their business every now and then. It doesn't happen so much anymore, but it used to happen in the early 2000s, where a broker would be not backing. It would be a dealing desk broker, and they wouldn't be backing it for too long, and then a person would have a huge win, and the broker would have to pay that person out directly, and they wouldn't have enough money to do that or something. So that's why it's really good to stay away from brokers that even offer a dealing desk option. It's best to have ones that only have the ECN and STP options for that. So let me go ahead and show you what.
Yeah, and if you think about it, it's kind of a obvious conflict of interest if they're taking the opposite side of your trade, right? If they can take the opposite side of your trade and kind of dictate the market prices, or like the reflection of the market prices, it creates just a conflict of interest that you don't want to be on the wrong side of, versus an ECN, which is, like I said, electronic communication network, where in theory they would just be as fast as possible putting you through to another trader or a pool of traders to take the opposite side of your trades, so they're not actually making money from you losing or winning trades. In theory, they should be making money from this commissions and spread only.
Exactly. That's you worded that really well. So here we have this is called CTrader, specifically 3.7. If you really care about that kind of specifics. So this is an alternative to MetaTrader 4 or MetaTrader 5. There's also NinjaTrader, and those are definitely the top four that people use. It's CTrader, MetaTrader 4, MetaTrader 5, and NinjaTrader, definitely top four platforms out there. There are more, but this is my personal favorite because it's written in C#, which is a much better language objectively than MQL4 or MQL5, which is what MetaTrader 4 and 5 are written in. Those are very obscure languages, computer languages. So that lets you do a lot more things on here. For example, I'm not actually going to place any trades because this is my challenge one for FTML, which I don't know if we'll probably talk about that. But I'll show you how what other features this one has that you may not be accustomed to having the option for on MetaTrader. So for example, if you were to do a limit order, you could say, well, let's just set up a trade on here where is this? So let's just say, I'll just use these lines on here. Let's say that we want to enter at this top purple line, and this on a stop loss to be at this bottom purple line. This is completely obscure. This is not necessarily a good trade at all. I'm not actually going to place it, but we're entering here for a buy limit, and then our stop loss limit is here. This is how you do that. So you go to a limit order, you say buy limit, you want to say how many you want to, or I usually wait to do that actually, and then depending on how far away my stop loss is, my entry price. So for the entry price, it's really easy. You just type it in. In this case, it is 2286.86. And then for the stop loss, it would be 2270.66. So these two lines here. And what's really nice about this that MetaTrader 4 and 5 do not offer on the base version, you can't have an EA that will display this information for you. On the computer version, never on the mobile though, is it tells you the estimated pip count, which by the way is completely wrong if you're using the indices. Never look at that if you're using indices. It's completely inaccurate. But it will show you the balance on account if you were to lose, if it was to hit stop loss. It'll also show you how much you'd win if it were to hit take profit. So for example, I'm just going to use this random number up here. So 2390 for a hypothetical take profit, and it'll show you that had I lost this trade, it would be about a 0.01% loss on account, and if I win this trade, I'll make 0.09% on account. Keep in mind we're on the 15-minute chart, so this is pretty zoomed in. That's why it's not very much money. It's a really large account as well. And it'll show you the exact dollar amounts as well. So lose $16, or it'll make 103 in this particular case. Which, by the way, most people see that as, why would you not take this trade all the time? It's just focusing on the ratio is a little too much in my opinion, because what also matters is how likely are you to actually win this trade. If price breaks this point here, it's much more likely to hit this point here, which is much closer, than reverse without hitting the bottom and then come up here before hitting this bottom point. So this trade is much more likely to lose than to win. So this is not necessarily even a good trade, even though it has such a good risk-reward ratio on there. Here's where it gets really cool, is with the stop loss. It has the default side right now, which means that if the bottom price, well, for buys it doesn't matter that much, but for the bottom price, if the bottom price hits this bottom thing here, it'll take out. However, the bid one. But if I want the ask to instead be the point, then you just click on this, it reverses it. So now it'll be the ask price that has to hit that bottom point in order for the trade to be taken out. And that's really good for sell limits more than buy limits, because then if there's a random event where spread goes super high and would normally hit your stop loss, it won't necessarily take you out, because it'll have to be the bid that hits it in that case, which is very strong, a useful technique here. And then, so that's my favorite features that they have on here. They also have something called a stop limit order. MetaTrader 5 also has stop limit order though, so that's not too impressive that they have it. They do have a couple cool features like close all buttons, things like this. I don't want this to be too much of an ad for CTrader though. So I just want to show you that there are other brokers out there, because a lot of people didn't even know that there's other brokers than MT4 and 5.
Platform.
Yeah, platforms, excuse me. Unfortunately, this one is exclusive to people not in the US, unless you do something like a challenge, because then it's centered in wherever the challenge is, and unless the challenge is from the US, then you still can't do it. It's a whole thing that they have on their website. You can learn more on there if you're really interested in it.
Yeah, so anybody have any questions, or like, Johnny, you have anything you want to talk about in particular, or like, just anything that you were hoping to get out of this?
No, that's definitely a lot of information. Thank you for all your time, both Zach and Blake. But I did have one question on the last chart that we were on in the other program. There's that thick bottom red line. and then you did the Fibonacci analysis
Me?
of that nature. I believe it was you, Zach. Yeah.
Yeah, I got it up right now. Hold on a second. Was it this one, or was it US?
It was the one previous before that, I believe.
What was I looking at? It might have been a bigger time frame. Let's see. Or maybe, I can't remember. What was your question now?
I'm just wondering how you do, so how do you, like, what's your thought process of when you want to start, like, entering the market? So you just kind of choose a price from where it's at right now, and then you decide, oh, it's going to go up? Or what's your...
like when I drew the fib?
Yeah.
Good question. So pretty much you wait until it goes back up. So give me 1 second to set this up. I'm trying to... I have this bar replay, and I cannot find it for some reason.
It's the, yeah, right there. Yep.
All right, perfect. Yeah. So if we look here, and let me get this rolling too. So if you look in what I actually sent, it was on my phone. So I marked this on my phone, but it was more or less this, right? So that didn't work. Okay, so all right, so pretty much I had the same thing marked on my phone, and I just waited until it actually retraced, right? So when I'm trading, I want to trade with the trend. I don't want to predict reversals if I can help it, right? So I was looking at this kind of a clear high right here. Looking at a clear high here, and then kind of a clear low after it started to kind of make this shape, which is, I don't use a whole lot, but it stood out to me. I said, okay, price is getting to be expensive, so I can sell it from this price. So I pulled out my fib, and I used 71 a lot, but I also was using, I think, 4-hour time frame, kind of this level here, pretty much 71. I said, okay, let's sell there, and I wanted to target, my fib level at 18,300. So like I don't ever expect or like know when price going to reverse. I just wait until it does, and then I try to keep trading in the same direction. So it did kind of get to the zone I wanted to, and then if you look at the present time at 15 or 15-minute chart, I had a high. Originally I had it here, but I decided to move it here. But the same principle remains, right? There's a high, and there's a low that has been created, and then once it does its thing, that's when you decide you want to enter. You don't have to predict a low. But to answer your first question, because your first question is like, how do I know when to get in the market, right?
Right. Yeah.
So there's what we call sessions in forex. So like in the stock market, you have it's open from 8 a.m. Eastern until 5 Eastern, I think. One thing that makes forex unique is that it's 24 or 5, but there is times of high volatility. There's sessions. There's the New York session, which is 8 to 5 Eastern. There's London session, which is when is London session?
Midnight.
Starts midnight.
Well, local time, Arizona time. I don't know Eastern time.
Yeah, and it goes until 8 a.m. Arizona time. And then there's Sydney and Asia or Tokyo sessions, which are kind of in the middle of the day, around this time. And there's highest volatility between London and New York sessions. So
the beginning of the New York one.
Mm-hmm. Yeah. So in that respect, I try not to trade around this time of day. So if you might have noticed in my Slack, I'll say I'm going to set this limit before I go to sleep, and then I'll see how I did over London session. So I'm not really ever going to enter a trade this time of day unless it's on a big time scale. But before I go to sleep, I will set a limit. So do you understand what a limit is, John, by the way?
In essence, but can you explain it?
Absolutely. So the way that I trade is I trade 99.9% sell and buy limits. What a limit is, okay, actually, the easiest way to explain it is if I were to explain what market execution is. So let's say I'll look at this chart, which I could do, and say, okay, I want to sell this right now. Then I would go to my broker, I would hit sell, I'll hit the button, and they would sell right now at whatever current price is. However, as you can imagine, to do that, that takes a lot of time watching the charts, and it kind of takes away your quality of life, honestly, unless you really enjoy that, which some people do like watching the chart go up and down. What I do is that I will set limits. So I will go to my broker, and I'll have a limit. And a limit is basically a pending order that says, as soon as price hits this level, execute a sale with this stop loss and just take profit.
Mm-hmm.
Or if I wanted to do a buy limit, I would say, okay, and this is where I would enter if I were.
And keep in mind, your phone can be off during this thing. Your phone doesn't even need to be on. It'll be 100% done in the cloud, essentially. So you don't need to worry about it whatsoever.
Exactly. You don't have to have the program in it. So I'll say, okay, as soon as price is here, execute a buy with this stop loss, and say the target will be here. And that's pretty much how I trade. That's a limit order. There's also a buy stop and sell stop. So there's stops and then there's limits. A stop would be, say that I said, okay, as soon as price breaks this level here, as soon as price breaks 18,200, sell it. Keep trading the same direction. So I can say, okay, as soon as price comes here, it's going to enter automatically. I did that because that's just how I think about it. But as soon as price goes to this level, automatically enter the trade and trade that direction. And lastly, of course, the buy stop would be as soon as price, it would be priced at a level above where it currently is. Say I said, okay, as soon as price gets up here, enter a trade and trade it that direction. So I only use limits. I don't use buy stops or sell stops unless I don't get to it, unless it's to hedge it. But yeah, so that's how I trade. I set traps for the market. I don't really ever market execute anything because it takes away my quality of life, I think.
Yeah, for sure. Thank you.
Yeah, you got it.
Yeah.
Now, granted, some people really really enjoy watching the charts go up and down. Like Blake is one of those people, and I'm not trying to talk shit about it. It's just not what I like to do.
Yeah, let me expand on why I like to watch the charts go up and down, so you don't all think I'm a psychopath. So let me share the screen. I don't think I did yet. Yeah.
And granted, if you do watch the charts, you can get a better entry. You can usually make more money, but at what cost, man?
So the way that I totally agree with Bert is saying, it would be really annoying to literally watch the charts 24/7. So what I do is I do it at only 2 different times. I do it whenever it's convenient, and also at night if I can. So like you said, actually at the beginning of London session is also pretty active for the U.S. markets, which is pretty interesting because it's after hours. Before market, and that's when the chart is actually pretty active during the London session. So that's kind of when the rest of the world is trading the U.S. stocks. So it does actually change a lot during that time. And so if I could only pick one time of the day to be on, it would be at around 1 to 2 a.m. Local time in Arizona. However, it really, in my opinion, actually, it doesn't tend to matter all that much. It's fairly consistent throughout the day in terms of potential opportunities. While if you enter on different parts of the days, you might see a quicker stop loss or take profit hit, especially if you're trying to do a really small trade. But because I do pretty larger trades in general anyways, I normally do like a 2-day hold, 3-day hold at the small end, which keep in mind it's actually pretty large for forex. Most people do intraday trading or even less. I see Bird rolling his eyes about that.
Yeah. No, just yeah.
Yeah, that's things like scalping and whatnot are proven statistically to be the very worst form of trading. Has the very worst percentage of people that win net of fees.
Let me explain. I don't think we should probably take the time to explain this. So there's like different time scales of trades. Starting from the biggest to smallest, you have position trades, which would, if you think about it, means it's more close to investing. Honestly, is say, okay, I think that the yen's gonna be very strong, or say I think the pound's gonna be very strong, so you would buy, pound versus US dollar and hold it for half a year, months, etc., or maybe weeks, but a long period of time. Then you come down to swing trading, which is what I would do more often than not. Swing trading generally is like, I would say, 2 to 3 days to a few weeks, as far as time scales go. And then you have intraday trades, which is kind of like the most popular, and that's more like day trading. Intraday is usually, I would say, a few hours to a few days. Granted, it's kind of a misnomer, I guess, a few hours to 1 day, but I think about intraday as a few hours to 2 days. And then you have scalping, which is like what people want to do as soon as they start trading. And it's basically you're trying to enter and exit a trade within less than an hour, pretty much, is the way I think about it.
So going back to that phrase I botched earlier in this, it was the 3 ways to trade. It's to be faster is the other one, smarter, or more lucky. And so if you do try to be the first one I said, to be faster in the market, I have something to tell you. There's machines that are physically located on beneath Wall Street, just so that the direct cord cable, it doesn't have to come from a different building other than the building that people place trades from, and that's how much they care about the speed of placing trades. Those machines are so fast that when someone if someone from a certain broker, such as Robinhood's been really in the hot water for this, not in the news so much, but if people that actually read finance news, they will send that data to this person first, who has a machine beneath Wall Street, and that person will basically they'll get either more liquidity, or they'll enter the same side position first, and they kind of have an initial bump coming if they know a big player is getting prepared to get in there.
Yeah. So I just wanted to explain the different time scales, and I do know one person who's very good at scalping. He trades under an hour, but he also has been trading for over 30 years, and he has experience in a lot of software. He trades in a room with literally. He's one of the guys going to meet almost in New York. He trades in a room with literally like 35 fucking screens on his wall, and like he has assistants helping him. Says, "Oh yeah, hit that one." It's ridiculous. Yeah. So swing trading generally is kind of what fits my personality best. I enter a trade without looking at it. I usually hold it for 3 or 4 days. So.
Yeah, so the way that you were describing is a way to get high blood pressure for the question. Yeah, I don't remember.
It is recommend people when they first start though, because you can. It's exciting. It's fun. It's exciting. You can make money quickly or lose it quickly. So it's, Warren Buffett has a quote that says the stock market is the way of transferring wealth from the impatient to patient. So. Not just patience and within a trade, like holding a trade with patience and when getting into a trade. It's what makes the biggest difference. It takes time.
Let me find my. Let me find my analysis really quickly. My current one for the U.S. market. So this will be much too advanced for beginner traders. This is my Elliott Wave analysis. And where it has a 2 here, this might be just as a B instead. If you're familiar with Elliott Wave, this 2 may be a B instead of a 2. For now, I still have a 2 because it hasn't broken yet, but if it does break, then it's definitely a 2. So this is one of my counter setups, essentially, to what's going on right now. And these should be all... I don't know what's happening there. But essentially, let me show you why I like to stay up for certain events. And when they trick you for entering these particular events, why it would still be worth it, in my opinion at least, to stay awake for them and be able to trade during the ideal conditions. And so, for example, we're looking at this 2 with the parentheses around it. So, for example, this, if you're familiar with Elliott Wave, I don't know, I keep saying that, is an intermediate. So, if you were going to subdivide the intermediate by 1, you'd use this minor wave, and I'm not going to talk about what exactly you're looking for, but this is what, I'll explain really quickly what you're looking for, but I won't go into detail on it. Basically, we're looking for entering off of a 5. Whenever you see a 5 on a smaller degree, that means that on a larger degree, it's changing direction. So, and if you combine this with another strategy, for example, let's use Japanese candlesticks, even though this wouldn't be a perfect one. There's a really, really nice Japanese candlestick right here, this red one here. I know it wasn't the very lowest. These two did come down, had their lows a little bit lower than this one. This one would not be bad at all. I'm only on the 1 hour chart. Let's just say, for example, that we entered here at the end of this one because we're watching the chart. I can't see what the time frame because this is in the way.
No.
What time is it?
19.
19. Okay, so yeah, so that is during the normal waking hours for Arizona, which is nice. Okay. And so if you were to take this trade, you'd only need your stop loss a little bit lower in this particular case. It's not always the case. Than the bottom of the wick here, and you'd be able to capitalize on an amazing risk-reward ratio. You'd probably take out on the A, for example, if you're doing a quick trade. This would be in my opinion, I say I have a little bit different time frame on what I say is what style of trading. For me, just to make things easier, I actually do consider a day trade less than 1 day of trading, similar to how the pattern day trading rule would say is 1 day. So if you opened at the beginning of the day and closed at the end of the day, that's the 1 day. But also if you open for anything in between, that'd also be 1 day. But if you open at the end of 1 day and then it held past the next day, even though that may only be 1 hour, that would still, according to pattern day trading rule, that wouldn't be that'd be 2 days. But I have kind of an in between one. So I like to do trades about this length, or to catch an A or a little bit above an A is usually what I aim for. I wait for an A to form, and then I use what's it called, Bird? It's extension of the fibs, algo targets.
Yeah.
Yeah, so I use an algo target. Yeah, extensions, algo targets, same idea. From the A.
Maybe since you're talking about Elliott Wave, just explain the most basic Elliott Wave, like 5 waves up, 3 waves down.
Yeah, and it's a little hard with this analysis. Let me see if I can go on to this other one over here.
Even if you're not on the chart, just explain like the general theory. Like even if you're just like not on any candles.
Yeah, so essentially what the rule is here's a better example of what a typical wave looks like. Is you'll have the first wave will be up, and then the second wave will come down, the third wave will come up, the fourth wave will come down, the fifth wave will come up. There's 3 rules that must be followed for an Elliott account to be considered valid. Or Bert always laughs at me when I say this, for it to be a legal wave, and it would be an illegal wave if one of these rules are broken.
You'll get arrested if you try to say you're wrong.
You definitely won't be arrested, but you'll be drawing your Elliott waves wrong, which is maybe worse, depending on how much money you actually have in the market. So the first rule is that the second wave cannot come below the starting or the starting place. So if the 2 came all the way down here, that would mean this chart is no longer valid. So we're no longer allowed to say that this is a 1-2 wave. The second rule is that the fourth wave, is written in Roman numerals here, it cannot come below the 1 wave. So it can't be below here. If this happened, again, this would be an illegal count and go to jail. Not actually. And then the last rule is that the third wave, so from the 2 to the 3, it cannot be the shortest wave among waves 1 itself, 3, and 5. And so that's distance vertically. And as long as the chart is following those 3 rules, you can count it as an Elliott wave. However, there are a lot of more tendencies, and then what I really focus on is the degrees. So inside of a 2 to 3 wave structure, there's a smaller 5 wave count. Each inside that one, there's another 5 wave count. on a 1 more degree smaller. And from a 1 to a 2 or a 3 to a 4, there's a 3-wave count. We call it an ABC. Over here's a really good example where you can see it clearly. Let me move it over here and zoom in. So from here, we can pretty easily see the price, even without me, I'll mark it, but even if I didn't mark it, you can probably see the ABC that I'm referring to, where it would go down, up, and then down again. And so because that happened, that's how I know that this is actually a valid second wave count. So this is perfect, good to go. And then these ones get subdivided again, but that's just getting a little too much into it. So as I was saying over here, with this example here, it's really critical that I'm able to enter right away when say this doji happens, or when a different symbol or different sign that the market is about to reverse in this area, which would be below the 3, happens, so that I'm able to catch this trade. If I miss it by just a couple hours, you'll see how immediate this price action is. Keep in mind, 1 hour chart. So even if I was to enter all the way up here, not only would the take profit have to be significantly smaller, but the stop loss would have to be significantly bigger. So it would have to be all the way down here, and that just absolutely ruins your risk-reward ratio. See, there's chat. Thanks for coming on. Appreciate you. So we have about 30 minutes left. So I'm thinking, Bird, that maybe we should just start marking up charts live, and we can show people exactly how we'd mark up a brand new chart. So,
Yeah,
so why don't you take the first lead on that?
all right, I can do that. It's been a second. I've been trying to get an education out here. Make something of myself. All right, so because of the market, I've been looking at US 30 pretty much, looking for opportunities to sell it the best I can. But I'll look at a forex pair for the first time in a few weeks. Historically, what I've had the most success on, for one reason or another, is NZD CAD. I'm going to go on a blank chart because everything is going to be outdated on it. So when I look at a chart, I usually start very zoomed out on the monthly. And from the monthly time frame, I kind of just want to look at the general shape of the chart, right? I just want to look at where it's headed, if there's anything glaring that stands out here. And here it looks like things are starting to trend down. We've come up, found resistance, and then we're hitting lower low, higher, lower high, lower low, lower high, lower low. So direction is down. So I'm telling myself, okay, I'm looking to sell it. And then I go to the same thing on a weekly time frame. Looking at this pair, seems to be some really crazy whipsaw price action here, which I've missed out on because I've been trading. This is a huge move. This is 700 pips this week, so it's kind of crazy. So now, when I get to the daily time frame, that's when I really want to get into like drawing lines and whatnot on the chart. So remember, from the monthly time scale, I told myself that I want to sell. But looking at this chart, this is actually bad enough. I would not trade this.
Hey, Bird, I think your audio is a little weird all of a sudden.
You know what? I had the laptop on my lap.
That's better now.
Yeah, it's in front of that thing. Basically, I was getting at, this is an ugly chart. I wouldn't trade it because the price action is too choppy. But let's look at Euro USD because it's usually, because it's so big, it's tough to, the charts will usually cleaner because these are the biggest. I'm trying to get one that doesn't have writing on it. These are the biggest forex pairs, so there's usually not a whole lot of or it's not as volatile, so it's usually easier to trade. So starting from the monthly, I kind of just look at the general shape of the chart from the monthly time frame. And it's trending down here. It is, if you look at this from the last 12 years, it's trending down. And I go down on weekly and I see this price action. And the first thing that stands out to me is that if you see, this isn't exactly level, but pretty much this wick here. We didn't really talk about Japanese candle patterns. We should have, but you see how it's supposed to be regular ray. If you look at this, you know, you see a wick come pierce this level and turn around. So it makes a new high, but then it turns around very viciously and makes a new low. So that tells me that it's likely just wanted to clear the board and wants to continue down the trend it's going in. So first thing I would do is I would mark two things on the chart, or one thing. I will mark this imbalance, which we didn't talk to and which we probably won't have time to get to, but I will look here, and I have a template for it. If I can, there you go. It's been a minute, it's been a good minute. So I'll look there, okay? So that's like the first place I'm gonna look at. Now I come to daily time frame. And the first thing that stands, and I have my direction of selling, that's my direction. I'm just looking for entry. So the next thing that stands out to me is this candle here. That is a downtrend, there's a move up before a move down. And I wanna look at the open of this candle. So then I look here. The next thing I would do is I would use a fib tool. So we're using kind of all the tools we used earlier. So I go from the high to the low. And I'm looking to see how deep this retracement would be. And this would be, because I'm not going to sell unless it's a discount, or expensive, I'm not going to buy unless it's a discount. So it has to be at least 0.5, preferably between 61 and 78. So this isn't a very deep retracement, but it's not a terrible trade for me to take. And I just go down on smaller time frames to get more and more information. And at this point in time, not necessarily a trade I would take because the risk reward wouldn't be there, but what I'll be looking at would be, you know, enter around the open of this candle. Stop loss would have to be really way too high, but I guess I could make it here above this wick, and then looking at the equal low. It's a 3-to-1 risk reward, which isn't bad, but it's not a very highly likely trade because of how low the stop loss would be on the fib retracement. But that's essentially what I do. I look at the monthly time frame for the shape of the trade, weekly for the direction, or daily for the direction. I look at the daily 4-hour and 1 hour to refine an entry. Hopefully we can look at one more and see if I can.
Could you actually do GJ?
Yeah. Ooh, that was bad. GBP, JPY. I know this is one of Blake's. This is Blake's favorite forex pair.
Yes.
See if I can get a blank on. Okay, so same thing, right? Monthly time frame. I see that we're kind of finding a lot of support here, and I just want to zoom out to see like historically where it is. And this looks like a very low price to be buying if possible. I just have the back of my head. On a weekly, this would really stand out to me because there was a level here that's pierced, and then it snaps back, right? So it's like, okay, perhaps it wanted to breach a low. The bad guys in the banks wanted to breach a low and then turn the price around, possibly. Then on daily, it's So this would be an interesting price because I wouldn't want to sell at this current price because it's already so low, and you know it will also be kind of tricky to want to buy it because like it's just been going straight down, so you're kind of guessing a low. But if I go on a smaller time frame, I can hopefully say what I would want to do. I don't have much of this. I wouldn't take a trade here. I will only take a sale, and the sale would have already happened. The sale would have been, most recently, it would have been just a regular fib play. So this high, this low, and between 61 and 78. So it would have been in this general area. What do you see on this?
So that's actually why I wanted to analyze it. I was gonna let you do your full analysis, and I was gonna show people how I analyze it, and then I was gonna explain that there's a lot of good ways to mark up a chart, and they can both be correct, and neither of them are better than each other. But I just want to go ahead and show how I would mark up the exact same chart as well.
Yep, go ahead. I'm trying to run downstairs. Good.
So a lot of fibs on this chart. Let's go over to current and see what we're looking at. Let's see if I can. Let's see if there's a more blank chart. Here we go. So I haven't marked up the 1-to-1. It looks like on GJ. So first off the bat, I do want to start on this on the 1 hour. I think the 1 hour is really good to get in the first initial look. And I'm kind of weird. Most people say go high and then go low. My favorite way to do it is actually start on the 1 hour and then go high again, and then I'm going to go back down low. And it's a little hard to understand why exactly, but this is how I like to do it. And by high, I only mean the daily. Once in a while, I'll look at the weekly as well, but that's not something I incorporate so much, just because I'm only looking for a good entry and a good exit, not so much a good hold or a position trade, for example. I'm not trying to hold GJ buys for 3 years or something. That's not my trading style. So I consider not only Japanese candlesticks, but also things like Tweezer Bottoms really important. So some people call it Tweezer Bottoms, or it's basically when you see wicks hit the same or very, very close to the same price on a significant time frame. Even in the 1 minute it matters, but for this being the daily, that matters even more. So let's go on now back down to a smaller time. Let's mark that first, and then we'll go into a smaller time frame after. And by the way, I do mark up indices differently, but that's all on YouTube. So I figured I would be a little more, a little different this time and mark it up on a currency instead. And then if I were to see, I want to see if there's an Elliott Wave possible. So it is possible to have an Elliott Wave on here. The C wave would be considerably larger than the the C wave would be considerably larger than the A wave, but this is a clear high up here. And I can definitely see the 5-wave count. I'll mark that on after, but this is basically what I'm looking at. And we'll get out this one as well. And look over here. This is definitely the wrong degree. So I'm not going to do a degree analysis right now. I'm just going to see what it is. So I'm just going to call these minor waves. It looks like it's about minor waves, so that should be approximately what it is. But it might not be exactly. So we have minor wave 1, 2, 3, and 4, and 5 up. And as we know from the rules, the 2 clearly did not come below 0. The 4 clearly did not intercept the 1. And the third wave should not be the smallest one. I'm pretty sure the 5 is smaller. Just to double check, I'll go ahead and get out the tool, because it's always good to double check these things. Sometimes your eyes can deceive you. So this is the size of the third one. Clearly the 5th wave is significantly smaller, and the 1 wave is also smaller, which that is what you'll see most of the time. Generally the 3rd wave is the largest wave on there. So for a C wave to finish, we actually have a 5-wave structure on there. So for a B wave, it's an ABC inside of an ABC. It's kind of funny. An ABC inside the middle of the ABC. So it'd be something along the lines of this. And of course, if that was the minor wave, this would be 1 degree less, which would be the minute wave. And now let's go ahead and get our analysis down. So for this one, I'll just use these letters, because we're subsecting a C wave, and I don't want that to be conflicted with the normal analysis. I usually make these ones yellow as well if they're subsecting a B, just to make everything super clear. I'm actually going to move that W, but I just put it there for a placement holder. So on first glance, this is how I initially mark up the chart. I usually change things after I mark it up, such as a W, because I want to see an ABC in between the W and the X. It's the same thing as a 5-wave structure, just labeled differently with letters instead of numbers. It's still 5. It doesn't matter. You can use a 5-wave structure as well. There's no correct way to do it. But I'm just trying to show you that we have this software. No, there isn't. There's none that do it well. I have seen other people try to do these. However, it's I've never seen one that's good enough to get my stamp of approval to answer Ray's question there. And then, so for over here, I can see an ABC in there of some sorts. I can also see an ABC in this little column area here as well, and neither of these X's would intercept the W. So the only thing we would check for is do we have some sort of 5-wave structure, really small degree, smaller degree than the one we're currently on, even possible for there, and that's where we'll know whether the Y goes here or there or whatnot. The good news is it doesn't matter. It actually does not matter for what we're doing right now. So what we're doing right now is actually we're just determining if this is a valid last point, because we already have one way to determine if it's the low, and that would be the Japanese candlesticks, which I don't know if I pointed out. I think it was on the weekly, which I just said I don't want to mark up. Yeah, on the weekly, the last week, it was a kind of a large-bodied dragonfly, a little larger than I'd like to see, but definitely still dragonfly, just because it has such a long wick, and that wick is the lowest low for, even lower than this one, which means it's the lowest for since 2012. It looks like. So let's go ahead and go back down to, we were in the 4-hour. Let's go ahead and go down to the 1 hour now. I'll go all the way back to where we were, and did it. I thought I had more. Oh, I turned off the markings. That's why. So what do we want to see now, and where can we enter on this trade? For what I would look for this is, I find out the structure. It would be a new 5-wave structure forming. So on an even smaller degree, this is not the minor degree. This would be a smaller one, maybe 2 degrees, maybe 1 degree smaller than the minor degree, which it's currently marked as. It'd be something along the lines of that. I think it'd be exactly that one, actually. Because while the number 4 does come below the number 1, you have to look at the actual chart. So this is actually valid. And let me show you why. If I have a line here, you can see more clearly that this is it doesn't actually even come all that close to breaking each other. So this is a valid count. This wouldn't be that high of a degree though. This would probably be this degree, maybe even a smaller one. Maybe even 1 or 2 degrees less than that. And so what exactly are we looking for now? We would be looking for an ABC down into a 2 to find our good entry, and then a 5-wave structure up. Not in those places. That's just a placement holder, because I'm on auto right now. So it'd be much higher. Something along the lines of that, as a very rough approximation. So now how would I find out exactly where to enter for this 2? Well, it's important to know where the maximum allowed according to Elliott Wave theory is. It's important to know where the tendencies say it should be, and it's important to look at the subdegree. Those are really the key things that I like to do. So I actually set them kind of in reverse order. I like to start with the subdegree. Also, this is the wrong degree. So I want to look for a 5-wave structure down, and something like the first point I could see it at is there. I could also potentially see the A being there instead. But if the A goes here, then we are allowed to have the B wave here. So we should actually see price come down a bit more. Let me fix this degree. This should be, we'll use this as the minor degree. Oh. Minor degree. So everything looks more uniform. Let me zoom back out really quickly just to check everything, see how it looks. Yeah, this is probably 1 degree less than minor degree, but we'll just continue doing this as it's on here. The degree doesn't matter that much. So how low can this C go? Well, it's already marked in the chart. It's this big old red line, because we know from the very first Elliott Wave rule that the 2 cannot come below the 0. It's illegal. So we're not able to see the price come down here. So generally what I do when I'm marking these up is I'll have the 2 at the maximum low point that I could see. And then I'll go on to an even smaller degree, because now I want to work with this subdegree here. So we'll go on to, say, the 30-minute or maybe even the 15-minute, just for extreme accuracy in terms of the chart data. I'll make it a little bigger so we can all see it. And now let's analyze this A and see if the A should go here or here. If I had to do one more smaller degree, it would be something along the lines of this. Yeah, so that didn't help that much, actually, unfortunately, because the Z could go here or here still. Okay, so it should go here, actually, because I was just eyeballing what the next ones have in play. The next ones meaning the degree that makes up this B. And this one looks good because if you see this B wave, which would actually be 1 degree less, be the minuet degree. In this particular case, it might be the sub-minuet. It probably is the sub-minuet, actually. These are probably all 1 degree too high if we're actually trying to get the correct degrees for this. But here, in between this one, we can see an even smaller degree. So this is the idea of fractals. This works infinitely, or not infinite, but it can go even smaller, even smaller on there. We're able to see good, nice B waves, and we can't see the A wave and the C wave on this one for this time frame. We could go into 1 minute and do that, but that's a little beside the point. That actually doesn't matter that much anymore. So just looking from this B wave, provided the price doesn't make any new highs, that would be the condition. If you're in my Telegram chat, then you're probably familiar with when I say conditions. So the condition would be price doesn't make any new highs. If the price doesn't make new highs, how low should it go? Well, we'd want to use this degree. So just for a refresher, this is the minuet degree. We'd use the minuet degree on this one, and we'd see that this could be here for now. It could be still forming, and then we'd want to see a down, up, and then one more down. So these are placeholder values for now. The X could be over here, provided it doesn't make a new high. Then it could still do that. And then we want to potentially enter around here. Now, last thing I want to do is I want to look at the fib chart for two different places. The first place is here. So just to see how much of a retracement can we expect. It usually comes down to an approximate level because the low part of the B wave here was so close to 618. I would actually expect it to not land to the 618, but probably come down to the 786. This aligns with our tendency, which I haven't mentioned yet, that the C wave of the same degree will often end near the 4th degree from the last count. So this 4 should be approximate, very approximate to the same place as the C. So now we're able to get a pretty good estimate, or I shouldn't say estimate, pretty good potential trade setup for the price being somewhere in here that will be the true low. For now, I'll use the 786. And the stop loss goes in a very obvious place. It goes right there. The reason why it goes right there is because provided price breaks down below this point, we care a lot because then that means we marked this up incorrectly because that would be a violation of our Elliott Wave rule. That's how we're able to put our Elliott Wave rule into practice. So for the take profit, that's why I have these levels up here. The take profit would be, I use typically one of these 3 points here, and I'm able to know much better once it actually starts. I'm able to use more techniques, but before it starts, I generally just use the -618 as a good ballpark for the next degree. So it'd be about like this. Probably not that quickly. It's unlikely to happen that fast. Again, this is just for visual representation. And by doing all these things, it may seem like a lot of work, but it definitely comes worth it when you look at the insane risk-reward ratios that you're able to get. So right now, it's a risk-reward ratio of 6.11 to 1. However, there's a couple other things that I usually do to try and get an even better risk-reward ratio than that. And one thing that I do, it's a very easy thing to do, is to copy this and paste it. And I'll have two separate entries and the same take profit. And keep in mind, I actually sometimes move my take profit to an even higher point, depending on how big the first subdegree wave is for once it hits this 2, wherever this 2 may land. And basically what this does is it lets you actually use the midpoint, provided these were equal sized positions, say 1 lot for each. These were each 1 lot, then you're able to calculate it as if you entered at the midpoint of these two for your real point, and that will be your actual risk-reward ratio if you get both of those two trade setups. So that would be about 9.1. It's covered there. There, now we can see it. About 9.1 for the risk-reward ratio. Be a little bit less than what it says because right now the take profit is going to be a little too high by a little bit. There we go. All right, maybe 8.9 is probably more accurate, which is a really, really good risk-reward ratio. That means provided you lose the next, let's say something even somewhat realistic, let's say you lose this trade, I don't know, four times in a row and win it the next, provided you were each using, you know, one lot, so that'd be 5 total times, you had to have, you've been able to risk 10 total lots at 10 different circumstances of similar conditions. Provided you lost the first 4, if you just win the next one, you'll be significantly way better off than when you started the 5 trades from 4 loses and 1 win. And so this is that's how I would begin to analyze a more accurate price for GJ here. And I'd wait until price came down a little bit, which is, again, that's why I do like to check up on the market. I would use check up more than watch the market to see how it progresses, see where this Y finishes. Does it really finish down here, or does it finish a little higher, a little lower? I might adjust. If the Y finishes, say here, for example, then I'd probably move this entry before it's even activated to a little bit lower on there, and then I'd have an even better risk-reward ratio. So this is really just how I would mark up this. So Bert and I mark our charts up very differently, but we're both successful traders, and that really just goes to show you that there are multiple ways to do it, but there are specific ways to do it. There's a lot of misinformation out of there, a lot of bad ways to trade too. I can very easily name a lot of the bad ways to trade off the top of my head, like RSI by itself. M's and W's are horrible in my opinion. There's a lot of other really bad ones. Those are the ones I really stress about people to not use. And so that's really all I want to show you. It is 8 o'clock, so we're gonna be wrapping up the Zoom here. I'd love to answer any questions. I can post this on I don't know where I'd post this, but I can post this somewhere on the YouTube.
Yeah, post on YouTube. I think that's a good place to wrap up. Just unless there's any follow-up questions. But like Blake said, there's Blake and I chart and trade pretty differently. But I think one thing we have in common is that we both have plans and we kind of stick to our rules. And there's a lot of ways to trade. But as long as you're consistent and kind of know what you're doing ahead of time, you should be successful. Or in the long run, you should be successful. So I think that's a good place to wrap it up. For sure.
Yeah, thanks so much for coming on, everyone. I hope you learned at least something or a lot for the newer people. And if you guys really like this a lot, we could potentially do these kind of things again, maybe at a more advanced level for the more advanced traders as well. We can just do more markups or whatever. So please, if you're on YouTube, please leave comments in the description saying what you'd like. And I'd love to hear you guys on the live chat what you guys thought of it as well.
And for sure, and feel free to join my Slack channel that I posted in the chat. I'm proud of what I'm doing there. I think it's pretty solid. So
I'll post my.
Hey, thank you guys for all the great content. I really appreciate it.
Yeah, for sure. All right. See you later, Blake.
See ya.
You guys take care.
So I posted my my Telegram on there as well, just in case anyone's interested in going on there. Again, thanks so much for coming on, guys. I really appreciate it, and I'll see you guys soon.